Hey guys, welcome to my channel. A brief introduction on me is I'm a college student based in New York, and I've been trading since I was 2019. Started off with equities and then derivatives in 2022. I wanted to give a brief introduction about the strategy that I just found out. Uh, I accidentally traded it. I didn't even know that we could construct payoff graphs. So what you're looking on your screen right now is a payoff graph of a couple of derivatives that you structure in such a way where you get such a payoff graph. Now, as you see, this is the payoff graph, and this is where the asset is currently, and these are 1 month expiry contracts. They expire anytime. They're going to expire in 4 trading days, and I constructed them, if I remember, like 10 days ago, or maybe like a week ago. But anyway, so um, the assets being over here and over here, so we did see P&L change over the period of time, but we're currently over here. So now let me tell you guys how this usually works. Now, you see the blue line? The blue line is the line, or it's the profit on any given time t as we go to expiration. And the green line is the value of the entire contracts that's been taken by me on expiration date. So you see there's a big gap between the blue line and the green line. That means these values do not are let me put it this way, they did not get the full value until until expiration date. So that's a good thing and a bad thing, because if you're out of position, you can exit these positions for a higher value than you can on expiration date. If you're in position, it's a bit of a con because you have to be on expiration, and volatility will add a problem to it. So that's the best part of it, is you basically have no risk and no loss. I either make $110 or make $15. So 3.1% of my portfolio and a 23% of my portfolio. So either way, it's not bad for a month. And if that's being compounded on a yearly basis, that would be around 36%. And if that was the case, it would be 230% above. But since the options that's being constructed, the derivatives we use on these payoff graph is actually in a much smaller width, we probably would say the probabilities of asset t expiring within this range at time t is going to be less using Poisson distribution. So we probably wouldn't. We estimated when I did this, I estimated that I would be expecting at least around $30 rather than $120. But the asset's kind of been moving here. Uh, it's been moving in and out of this position for the past couple of days, but I do believe we might see it expire here in the next 4 trading days. Hopefully it does. If not, I will exit at any point in time t below here for at least $45 to $50. So yes, that's if you have any questions, and if you want to know how I built the payoff graph such a way, please let me know. Please comment and let me know if you guys need to know that. I will create another YouTube video on how I did this and how you guys can potentially do this, where you can make money with no risk. Alright, thank you.